want to understand the central dilemma of this market, take a look at Federal Realty, the incredibly well-run shopping center real estate investment trust with properties in wealthy areas across the Northeast Mid-Atlantic, and they're beautiful, okay? Last night, Federal Realty reported a darn good quarter, a nice top and bottom line beat with robust guidance. In fact, in this morning's conference call, CEO Don Wood described it as, and I'm quoting, the best quarter we've ever had, end quote. And what happened? Stock barely budged. It's still down more than 6% for the year. Is that right? Now, some of this is because the REITs are simply less attractive stocks in an environment where investors are worried about rising interest rates. Federal Realty sports a 3.3% yield, but that's not much higher than you get by owning a risk-free, let's say, 10-year Treasury. At the same time, a lot of people are still concerned about a Fed-mandated slowdown, which would not be great for retail. So what can investors get excited? When can they get excited about Federal Realty and the REITs again? Particularly Federal Realty because of its long history of dividends. Let's dig deeper with Don Wood. He's the president and CEO of Federal Realty Investment Trust to learn more about the quarter and what lies ahead for one of the largest landlords in America. Mr. Wood, welcome back to Mad Money. Good to see you, Don.
Thanks for having me.
All right. Greatest quarter ever. How does that translate to someone who says, you know what, I love that guy, but I'm getting that 3.5% on my 5-year CD?
Well, let's talk about what it means, first of all, right? When I say the best quarter we've ever had, you know, REITs are measured by funds from operations per share, $1.58. We've never done that much cash flow per share in a 90-day period of time. And it's not an anomaly. It is the direction that we're going. I think we are the only shopping center REIT, certainly, that has increased cash flow every single year since the since the recession back in 9 or 10. But it's that dividend question that you just asked, just talked about that I wanted to address for a second.
Sure.
If I can, you know, there's no question yields are up on bonds.
Right.
So as I sit and I look at Federal's 3.2 or something like that percentage yield on from a dividend perspective, you have to say, well, is that it?
Right.
Let me ask you this. And this number blew me away. There are 26 companies, all companies, everywhere in terms of public companies that have a record of increasing their dividend every year for 50 years or more. 50 years. Federal's one of them. Procter & Gamble's another. Coca-Cola's another. Those three are the only ones today that have a 3.2 or 3.3 yield. The rest are below that all the way through. So stop and say, this guy has, first of all, this is a special REIT. It's not like most. Now let's go further. With the stuff that we have done and have announced and some stuff that hasn't been announced, we've got the ability or are highly likely to grow cash flow and earnings again 19 over 18 and 20 over 19 from things that we're
You actually have that level
today.
of visibility. Procter does not and Coca-Cola does
Well,
not.
that's it. Thanks. I appreciate that, too. You know, and so when you sit and you think about that, it's hard for me to say that this is the same as a bond. Capital appreciation is important.
Yeah,
and if you were to liquidate this company, Federal Realty today, sell every shopping center, we would effectively get significantly more than the stock is trading at today. That should matter, too, from a bottom level
Absolutely.
perspective.
Now, let's talk about things that have happened in your industry to make you more confident than I've ever seen. Okay. One is there's been a change in the mixed use that you put together. It's no longer just a shopping center. And then the second thing is that it's very clear to me that the omni-channel brick and mortar side actually may be an advantage versus the just all online.
It's really interesting in terms of what's changing in the marketplace and how the consumer is growing or adapting, whatever. When we sit and we think about our company, we basically, our core competency is putting the right retail together in any particular location to create a place. And those places are just in that first ring suburb, usually out of the centers of the major cities along the East Coast and California. But once we have them there, how about following the trend, which we've been doing for 20 years, of saying, you know what, people are sick of traffic, people are sick of, people are looking to efficiency and things like that. They want to live, they want to work, they want to effectively have their lives at these environments.
So if I'm working at Splunk, I want to have
Why'd you choose Splunk?
Because they're one of my favorite companies. And
Me too.
With you. They're a brilliant company.
They are.
I just think they're incredibly well run. And if I work there, I would like to have this at my convenience rather than at my home. I'd like it at my work.
Yeah, and as a result, I mean, we now have completed 2 buildings, office buildings, in our retail-based company for Splunk. And that's in Silicon Valley at our Santana Row community. And I got to tell you, with what we hear from their employees, with how we see them using the entire property, the office and the residential are integral to how the retail is
And how
used.
about the fact that you already know that every time we always say, oh my, what happens with a bankruptcy? I see it's very clear that any opening, you're renting at a higher price than last year.
Well, that's right. And again, if you're in the right locations and you're at places that effectively are in demand exceeding supply is an important thing. And that's not the case for our industry in total, I don't believe. Can I hit on one thing that you just talked about? You know, there's an awful lot of online companies that just several years ago would say we don't need bricks and mortar, right? We are online, it's more efficient, et cetera. But the cost of acquiring a customer is a hard thing to do. And obviously the last mile piece of how to deliver goods to that customer is certainly not all figured out yet. There are dozens and dozens, and I might say hundreds of not even startup anymore, but established online companies that are saying bricks and mortar is a critical part of what it is that we do. All right,
one last question. I don't like a Fed that says maybe we have to overshoot to slow down the economy. Everything I hear from you is that things are just really good. What's the matter with that? Can we let it go, or does the Fed have to slow it?
Well, look, I got to pick the things I can control and the things I can't control, right? From the glass half full part of this conversation is, you know, with interest rates rising, interest rates are only rising because the economy is doing well. The economy is doing well, consumers are doing well, and we're in a consumer business to some extent. So from my perspective, that balance and how that works it's above my pay grade. But I got to tell you, things look pretty good.
Well, you know, we just got Starbucks numbers tonight. Looks like there's people coming back to the shopping center.
That's an important tenant to us. That's an important tenant, Starbucks says to us. It's part of how you want to live going forward.
Perfect. Well, I want to thank Don Wood for putting it all in perspective, as he always does. Don Wood, Federal Realty Investment Trust, President CEO, the only real big real estate REIT that we're recommending. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.